welcome back to my YouTube channel, Kite Swift Moves Trading Academy. So today we're going to be looking at another strategy, and what you're going to be looking for is pattern recognition. And the kind of pattern we're looking at is you're going to be looking for an area on the chart where you've got a bullish run or activity on the price action. And you may recall that bullish in the trading term in the world means that the price is going up. So you can picture a bull that's got his head down and he's taking his horns and he's grabbing that matador and he's flipping them up in the air. That's bullish action. The other one is bearish action. So that's where you can picture a bear up on its hind legs, claws up above its head extended out, and he's swiping down. So that's representative of the stock going down. Okay. So we're looking for bullish action, and what I drew here, this is the kind of like an example of the pattern that you're looking for. So what you have here with bullish action, you have new higher highs, and you have a low, but then you have a new higher high, but new higher low, new higher high, new higher low, new high. And then what you're looking for is you're going to have a break in this structure, and what's going to happen is it's going to come down, and you're going to have what we call a first low, and then it's going to pop back up, and it's going to go. And this could pop up back up, and like over here, it could just come down, or it may run for a while and come down. But I am so sorry. Excuse me. And along with establishing this first low is that you also will establish a demand zone. And I didn't really draw that too well. Hold on a second. I'm still getting used to this particular tool. And I'll show you how you establish that. But you have this thing called a demand zone. And all right. Anyhow, so let's go back to our price action. New higher high, new higher low, new higher high, higher low, so forth. And all of a sudden it starts coming down, and you're going to establish your first low. Okay. And then the price action is going to go back up. Now this is the no trading zone. You're not going to trade in here. This isn't what that's about. This is just to show you that it didn't go through and didn't break through this demand zone. If it does, then it invalidates this setup structure and you don't trade it. But it goes up, and then all of a sudden it comes down, and it's going to break that first low, and sometimes, but not always, but oftentimes it's going to break down into this demand zone, and then it's going to shoot back up. Now, when it crosses over the top of this demand zone, or this line equal to the first low, that's where you're going to look to get into the entry on the stock, on your purchase. I'm talking options here, obviously. And you're looking for it to go up. So look at that pattern, study that for a little bit. Now let's look at, let me hop over here. No, wrong one. Where is, oh, well, hold on here, folks. I got to find them. Oh, that's not good. Hold on. I got to find my files. And open. All right. So that's this is the one I'm looking for right here. So the 4 hour. So on your chart, you're going to pick the stock that you want to do your technical analysis on, and you're going to, with the 4 hour time frame, that's what this is showing, what you're going to do is you're going to look for bullish action. And this is right here. This is bullish action where it just the price is going up, going up, going up. So then from there, you're going to be wanting to drop down to the 1 hour. Now, I labeled a lot of this stuff here on the 1 hour. Realistically, you would have dropped down to probably the 15-minute window or a 15-minute view. Now, these views, all it is like if I'm at a 1 hour view, that means every candle is 1 hour. If I'm at the 15-minute view, every candle is 15 minutes. 1 minute, that means every candle, a new candle is being formed every 1 minute. So this is looking at the 1 hour. So let's break this down. So what I did here was this was bullish action going up here. And so I used the circle tool and drew circles to identify that. And then you notice here that the price started to come down from this candle here. So it came down and kept coming down. And so we established the first low. All right. And now from the first low, as I was saying before, your price is going to go up, it's going to go up, and then all of a sudden it's going to start to come down. And so this was your first low. And also the demand zone, I don't really have this. I changed the scaling on this, so why things look a little funky right now. But if you go to this candle right here, this is where the demand zone was based off of. So then your price range is going to price action comes down. Look how it broke the first low, and now it goes into this demand zone. Now sometimes it'll get down this demand zone, it'll kind of bounce up and down a little bit inside, and then finally it'll come out. But that's what you're looking for, is for it to break away. Like here, now it came down, it touched it or broke through it, and then straight away it started rising. And and I do apologize on the timing factor on this screen. This is it's kind of a little messed up, is what it is. But anyhow, what I tried showing you here is the price range from right here, this purple candle, right, kind of a little to the right of the FL, all the way up to here. And if you're in this, that's what you would have stuck to. Now, you could have continued riding this out because the next candle was a black candle, but it actually was higher in price. That's kind of a judgment call while you're in your trade. But say worst case scenario, you would have had a $3.96, say let's call it $4 change in the price action on the stock. And what that means is typically your delta on your option is 50 cents. So every dollar that the stock goes up in price, the contract goes up 50 cents. So in essence, this would have been a $2 gain on the contract, but that's per share. And there's 100 shares inside one contract. So you do the math, you would have had close to, basically you would have had a $200 run, but that is for one contract. Now imagine if you had 10 contracts or 100 contracts. And that's how these kind of things can scale. But what's really cool about all this is this setup repeats itself and repeats itself and repeats it. It's almost like printing money. Seems like it some days, but anyhow. So with this type of setup, and now let's back up a little bit. It came down to this first low. It came up here. Now, if it would have came down here and it broke through this first low and it got into the demand zone, had this kept going down and broke through into here, then neither of us would have stuck with we wouldn't have done the trade. Because if you come down through here and you break this demand zone on the bottom side, you just invalidated all this setup. So those are the kinds of things that you're looking for. If it doesn't come back down and it just keeps climbing and going on, then again, it invalidated this setup structure, and it's the setup structure you're looking for, because when it makes this move right here where it shoots up, is you want to know when and where that's happening. You don't want to just be speculating throughout the day, guessing or whatever. You want to actually do it it's very efficient, and it's quite promising. So anyhow, I think that. Oh, wait a minute, I got ahead of myself. So this was on the 1 hour window. I sure did. I'm sorry, I got ahead of myself here. So now, when you actually enter into the trade, you're going to then drop down to either the 1 minute or the 5 minute window, because as you're in the trade, you're going to want to really stay right on top of that position, and you're probably not going to be in it for very long. So two key things to key takeaways to remember: not for long, and you want to know where you're going to get in, where you're going to get out. So anyhow, and that's what with your short term candle time frame, then you're actually able to monitor and stay on top of that. So as you start to see this, like even here where this developed a black candle, I would have been a little concerned, but the fact that the wick is taller than the previous candle was a good sign for it. Then the next one was purple, and again another black one, but it didn't go shooting way down, and it's really almost completely mimicked the purple one. But then this next one shot up, and that's what you're looking for out of this type of trade. And one contract isn't going to make you a lot, but you can scale it with multiple contracts. But once you do this often enough where you get comfortable and confident that this test setup works, I think you'll find that this time has been well spent. Anyhow, I hope that helps you. I hope you make plenty of money on the market.